income versus performance, and our market forecast for Cantu Tactical Wealth Management. Today is April the 8th, 2024.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
Income versus performance. So let me address this issue first. So April 15th is around the corner, and I wanted to mention this video because a client of mine received a phone call and said, Joe, the accountant said that our firm isn't providing enough income for the client. But what was interesting is that the customer was a little bit confused as to why the accountant would say such a statement. And then, I realized that the accountant is just looking at the 1099. And so you got to understand what the accountant looks. They look at income tax. So let me say that word again. Income. So they're looking at the interest and dividend income on a portfolio and computing taxes from the 1099. But yet I had to point out to the client that performance was more important than dividend income or interest income. And as a matter of fact, in the last 3 years, it could have been a problem in a retirement account if they were overweighted in fixed income. So that's what's prompted me to make this video on income versus performance. So let me explain. The best example is to talk about, say, energy stocks, for example. So in my example, I'm going to use an energy stock, and let's say it pays a 3% dividend. So we have a stock that pays a 3% dividend. Now, that's not the performance of the stock. That's simply the dividend. Now, what's even more important to understand is that dividend is a return of principal, and you get to pay tax on it. And I will explain that in a moment. But first off, in my example, I'm going to say that this stock, let's say for the year, for a 12-month, trailing 12-month period, it increased in value approximately 12%. Now, in my example, it pays a 3% dividend. It increased in value 12%. So what was the performance of that investment in this particular case? The performance was 15%, or 15% was the total return for the client. So you made the 3% dividend plus the stock increased 12%, so the total return of this investment was 15%. That was, quote, the performance of the investment. Now, let's use the converse of the situation. Let's say that the stock went down by 7%. So in my example, stock B, for example, let's say, went down 7%. So now, what is the total return, or quote, the performance of the investment for the individual, for the customer? So if you make 3% and the stock goes down by 7%, then the performance, the overall performance for the customer was a minus 4%. A minus 4%. Because you went down 7%, but you made 3% on the dividend. So you're down minus 4%. What does that mean? That means overall the performance was negative. The customer lost money. So when it comes down to it, it's like, who cares what the dividend is if you're not looking at, quote, the performance? So here at Cantu Tactical Wealth Management, we look at the performance of investments. And that includes the dividend and interest income. Let's talk about dividend income and the fact that dividend income is really a return of principal. And you get to pay taxes on it in a taxable account. So what does that really mean? And let's kind of understand that. Let's understand that concept here. So in my particular case, I'm going to give the example. Let's say that stock A, this energy stock, say the earnings per share were $10. We're just gonna make that up, but say they were $10. Now that's the earnings per share that the company made, let's say for the year. Now earnings are reported every quarter, but let's say they were $10. Now, from that $10 over the quarter, let's say that they went ahead and they stripped out $3 a share from their earnings. So now the company of the $10 only has $7 a share to reinvest in the company. And now they've taken $3 out of that earnings per share and given it to the shareholder as income. So basically what I'm saying is, in a way, had they not given that $3 a share and had they kept that full $10 a share, that full $10 a share would be inside the stock. It would be inside the value of the stock. That $10 a share, when a company earns earnings and they keep that money, that value of $10 a share is pushed into the total value of the company. Total value of the stock price is another way to say it. Now, if they turn around and they release $3 a share, and let's say in our example, it represents 3%, what has happened? Basically, they're giving you a return of principal that you already had inside your stock. In addition to that, you get to pay taxes on it. Now, that's not very good when you think about it. But what I'm saying is that you have to take the two factors into account. Is that you have a stock with a stock price and the value of the stock, and you have to understand that 3% was really a return of principal and it just caused you to pay taxes. So in the long run, does it really matter about the dividend on the stock, or does it matter about the overall performance? And the answer is, it really matters more about the performance of the stock. As I gave you in the example earlier, who cares if you're making a 3% dividend if you're losing 4% on your investment? And that's why I'm saying income versus performance. On a retirement portfolio, performance is more important than the income that you receive. And again, when you talk to an accountant, all they see is, quote, the dividend income and interest income, and then they pay taxes on it. But they may not be looking at the total performance of the account, which is much, much more important. So my point is that it matters. So like in our particular case of this client I was talking to, the performance was a double-digit return. Again, it doesn't matter about the income stream in it, because for a retirement portfolio, you can always sell a stock and create income on a withdrawal basis, and you're actually withdrawing from the capital gain of that stock. And let's talk about it. I'm not a tax advisor, and here at Cantu Tactical Wealth Management, we don't give tax or legal advice. So that's a disclaimer I need to say. But the point is that, when you look at the taxes for the income, the dividend income versus a capital gain, if it's in my understanding, if it's a long-term capital gain, you may actually pay less tax than the income. And I don't know, you have to check with your tax advisor on that issue. But my point is that there's some stocks that are doing extremely well that don't pay a dividend. And so we're really looking at the performance of that stock overall. All right, enough about that. Let's talk about the market forecast here at Cantu Tactical Wealth Management. Ronald Liston and I, we have a saying that we follow, and it's, quote, "Don't fight the Fed." So let me give you some basic economic fundamentals in that saying. If the Fed is raising interest rates, in general, the economy is doing well and it's on fire. If the Fed is lowering interest rates, the economy is doing poor and it needs to be repaired. Let me explain. The Fed raises interest rates when it sees a heated economy, so it tries to get, quote, inflation under control. Now, you have seen that. If we go back within the last 3 years, you will remember when interest rates were at 0. You couldn't even get 0.5% on a 1-year CD. Now, you can get around 5% on a 1-year CD, above or below, in general. So the Fed raised interest rates. Now, how does this relate to a retirement portfolio? So in looking at a retirement portfolio, if the financial planner, investment advisor, whatever, based on age, said that this person needs more fixed income or interest and dividend investments, when the Fed is raising interest rates, those investments actually go down in value. You actually lose money. Why is that important? That's important because if, quote, the accountant, who's not in our business, they're in the business of doing federal income tax or taxes, says to you you should have more fixed income, in the last 3 years as interest rates went up, you would have lost money. Matter of fact, in age-weighted portfolios, I call this, quote, age discrimination, that many retirees who had, say, more than 50 or 60% of the portfolio over the last, say, 24 months, you probably lost money because as interest rates went up, those investments went down. That's a basic premise of investments. Now, as interest rates go down, those investments typically go up in value. That's right. As interest rates go down, those investments typically go up in value. So it's important to understand, is the Fed raising interest rates or are they lowering interest rates? And that dictates as to which asset class, in our opinion, that we favor in our investment portfolios. So if the Fed is raising interest rates, then we favor equities. Equities historically make more money in a rising interest rate market. Likewise, if interest rates are falling, fixed income typically makes more money in a falling interest rate environment. Now that is just basic economics about what's going on with the Fed and your interest rates, or the interest rate policy, let's say, in the United States. Let's talk about our market forecast here at Cantu Tactical Wealth Management in April of 2024. And I will break this down into three components. Number one, the overall U.S. economy. Number two, the market. Number three, our actions here at Cantu Tactical Wealth Management. Number one, let's talk about the U.S. economy. There are many economic indicators that we follow. The granddaddy of all is gross domestic product. But inside the gross domestic product, one of the economic indicators that we have been following for the last 3 years is the jobs number. Now that's very important, in our opinion, to understand that the jobs number has been very strong. It's also been one of the rationales that over the last 3 years, if you see the other videos on this channel, you'll notice that I have been saying that the U.S. economy is not moving into a recession. Many economists, probably 80% roughly, as an estimate, of the economists on Wall Street felt we were, but we in fact were correct that we weren't. And one of that is the jobs number. Let's talk about the jobs number that just came out. That jobs number was about 300,000 jobs for last month. What were they predicting, economists? Again, economists got it wrong. They were predicting about 200,000 jobs, and they came in with 300,000 jobs. That's what was the number despite the forecast. How does that reflect on the U.S. economy? It shows that we still have a strong economy. Now, our forecast for the United States economy is the economy is doing well going forward, monitoring the economic indicators. Now let's talk about that in relation to the stock market. In general, here at Cantu Tactical Wealth Management, we have a phrase that we say in this particular type of environment of a rising interest rate market. And that is that the stock market will follow with long-term upward performance with short-term pullback. Let me say that again. The stock market is good long-term with short-term pullbacks. There's many things that affect the stock market itself. The weather, geopolitical events, earnings. Anything can really affect the stock market, and it causes short-term volatility. So when we say in general that the stock market, our market forecast is that it's good from a long-term approach, we do say that in general it is going up with a short-term pullback. Now let me discuss our actions here at Cantu Tactical Wealth Management. So despite the fact that we have a strong market, we noticed that last week that the market had a significant sell-off based on some geopolitical situations that were occurring in the news. And based upon that, it set off one of our indicators that we use here at the firm to say that we should start hedging the portfolio. Now, what does that mean, hedging the portfolio? That's another word of saying protecting the portfolio. A hedge is a protection on the portfolio for a downward moving market. So what we have done is we've taken a portion of the assets and we sold them and then turned around and we placed a hedge, a protection hedge on the portfolio. We have investments in there just on a portion that if the stock market moves down, these investments actually go up in value. That's right. If the stock market moves down on these particular investments, they move up in value. And that is called hedged. So, or hedging. It's a hedge. So in general, we have starting a hedging process, and if for some reason the market sells down more, then we will hedge the portfolio even a little bit more. But it's important that you have peace of mind if you're a Cantu Tactical Wealth Management client, customer, that we are taking action to protect the portfolios in case there's a downward turning market. And the reason behind that is because the market is so high. We have done so well in the trailing 12 months. And so we want to protect those gains. So that's why we're beginning to hedge the portfolio. Now, from another aspect, what if the stock market continues to run up despite the fact that we have this hedge in there? In other words, the hedge is in there for some down days for the market. But if the market continues to rise, we will remove that hedging. We will remove that hedge from the portfolio. So we will have better performance in equities moving forward with a rising market. We want to participate in the gains of the stock market if the market is moving up. Anyway, that's our market forecast here at Cantu Tactical Wealth Management. I have some disclosures at the end. Take a listen.
Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management and Joe Cantu are a fiduciary firm and registered investment advisor in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.